What if I told you the modern debt trap was created overnight? Our grandparents built real wealth, but today's system punishes savers. Stick around for the 1971 Antidote, the hidden historical strategy you need to protect your family's money. Before 1971, the American dream was built on a very simple, almost sacred principle: sound money. Our grandparents and great-grandparents operated under the belief that a dollar saved was truly a dollar earned. Why? Because that paper dollar was literally a receipt for physical gold held securely in a vault. During the frugal decades following the Great Depression, families built formidable wealth simply by keeping their money in a local bank. It was an admirable, deeply resilient strategy. Because the currency was tied to a hard, finite asset, inflation was historically low. Simply holding on to cash protected their purchasing power over time. They didn't need to be Wall Street day traders or take massive risks to retire with dignity. Their money naturally held its value. Modern economic historians confirm that during this sound money era, a modest, disciplined savings rate was mathematically enough to secure a family's future without the constant anxiety of economic collapse. So, how do you apply this lost secret today when regular bank accounts yield pennies? You have to artificially recreate that protection. Never leave your hard-earned cash sitting idle in a basic checking account where modern inflation silently eats it alive. Instead, systematically park your emergency reserves in high-yield savings accounts or short-term treasury bills to immediately claw back the purchasing power the current system is trying to steal. On August 15, 1971, President Richard Nixon went on national television and temporarily suspended the convertibility of the dollar into gold. This infamous Nixon Shock severed the ancient cord that tied our money to a physical reality. Overnight, the world entered the era of purely fiat currency, money backed by nothing but government decree. The disciplined, traditional rules our grandparents played by were suddenly shattered. Without the strict, finite anchor of gold, the supply of money could be expanded at will. This fundamental shift inadvertently gave birth to a perpetual cycle of inflation. It slowly eroded the value of traditional savings and pushed everyday hard-working families into a relentless modern trap of borrowing and credit cards just to maintain their standard of living. Recent economic data and modern financial planners starkly confirm the fallout. The purchasing power of the dollar has plummeted drastically since 1971. The cold math of inflation proves that hoarding cash under the mattress is now a guaranteed way to quietly lose your wealth over time. So, how do you survive this structural shift today? You must stop treating fiat cash as a permanent vault. Instead, view your dollars strictly as a temporary conveyor belt. Limit the liquid cash you hold to just your basic emergency fund. The moment you have a surplus, systematically convert those depreciating paper dollars into things that hold real value, starting by paying off toxic, high-interest consumer debt immediately. Ancient proverbs have warned us for millennia that the borrower is slave to the lender. Our ancestors understood that debt was a dangerous form of bondage, not a convenient tool for lifestyle upgrades. In the past, going into debt was a last resort, a survival tactic reserved for absolute emergencies. But the post-1971 system flipped this wisdom upside down. Because fiat money constantly loses value, inflation acts as a silent, invisible, phantom tax on your hard-earned wages. Modern financial experts point out a twisted reality. This system actually incentivizes you to borrow. Why? Because you get to pay back your loans with dollars that are worth less tomorrow than they are today. This creates the ultimate modern consumer trap, pushing everyday people to finance cars, clothes, and vacations, keeping them chained to a treadmill of endless payments. If you are tired of this modern debt trap and want to join a community dedicated to building real, independent wealth, hit that subscribe button right now. So, how do you break free from this phantom tax? You have to aggressively opt out of their consumer credit game. Make a hard rule today. If it depreciates in value, like a car, a TV, or a wardrobe, you never finance it. Starve the system of the interest payments it expects from you and redirect every dime into building your own financial fortress. Before digital banking and endless credit, true wealth was measured in things you could actually touch. Think of the traditional homesteaders or Depression-era survivors. Their security wasn't tied to a volatile stock ticker, but to land, tools, and tangible goods. This is the ancient principle of the hard asset. When historical banking systems collapsed, families who owned undeniable physical assets weathered the storm. A plot of land could always grow food. Precious metals held universal trade value. It was the ultimate resilient fortress against the failure of paper promises, ensuring their family's survival when the economic world turned upside down. Modern economic data confirms this ancient wisdom is the key to protecting your wealth today. Since the 1971 shift to fiat currency, the prices of hard assets, like real estate, commodities, and even fractional ownership in producing companies through index funds, have historically surged. The math of compound growth shows that owning real things outpaces the silent drain of inflation. So, how do you practically revive this strategy? You must stop storing your life energy in depreciating fiat. Start building a habit of routinely converting your excess paper dollars into modern, hard assets. Whether it is investing in real estate, consistently buying broad market index funds, or purchasing durable equipment for a side hustle, protect your wealth by owning things the system cannot simply print more of. For generations, self-reliant communities like the Amish have understood a profound financial truth. True wealth isn't paper, it's production. They rarely focus on hoarding cash, instead investing their resources into tools, land, and tangible skills. This is the ancient principle of productive capital. During the darkest days of the Great Depression, the families who survived and eventually thrived applied this exact resilience. They didn't just bury cash in jars. They owned things that produced value regardless of what the banks were doing: a sewing machine to mend clothes, seeds to grow food, or tools to repair machinery. Their wealth was active, not passive. Modern financial planners and the math of compound interest confirm that this historical habit is the ultimate defense against the post-1971 inflation machine. Wealth today isn't built by saving a dying currency. It is built by acquiring assets that generate cash flow or appreciate over time. This brings us to the 1971 antidote I promised you. To survive today's economic turbulence, you must shift your mindset from consumer to producer. Stop trading your time for depreciating dollars just to buy dead liabilities. Instead, treat every dollar you save as a tiny employee. Put them to work acquiring your own productive capital. Whether that means funding a high-demand certification to increase your income, buying equipment for a side hustle, or systematically investing in the dividend-paying index funds. The system may have fundamentally changed back in 1971, but the ancient rules of wealth building were never truly destroyed. They just require a little more intentionality today. The modern financial machine desperately wants you to remain a passive consumer, constantly trading your hard-earned time for depreciating paper currency and burying yourself in high-interest debt just to keep up appearances. But now that you know the hidden history, you have the ultimate power to permanently opt out. By reviving the resilient, frugal habits of our grandparents, avoiding the phantom tax of consumer debt, embracing the undeniable security of hard assets, and systematically converting your cash into productive capital, you can build an unbreakable financial fortress for your family. You do not have to be a helpless victim of inflation. You simply have to stop playing their modern game and start playing your own. Now, it is time to officially choose your survival strategy. Down in the comments, I want you to pick your side. Are you joining Team Hard Assets and focusing on things like real estate and index funds? Or are you joining Team Productive Capital and investing heavily in new skills and side hustles? Drop your vote below right now. Stay resilient, and I will see you next time.